What is going on, guys? What is going on? Just waiting for Uncle Jerome to speak. So, Uncle Jerome is testifying before Congress on monetary policy and economy. This is different, obviously, than the FOMC meeting. His testimony is required before a few committees. So, don't expect him, in my view, do not expect him to telegraph the Fed's entire position. It would be unwise to do that. However, there is some news that came out that already sort of hints at what he's going to say. Fed Chair Powell notes highly uncertain. This is the article. Fed Chair Powell notes highly uncertain Ukraine impact, but says rate hikes are still coming. So obviously, I don't think that's a surprise to anybody. I think that the amount of the rate hike, which there's no interest in, there's really no benefit in him telling you exactly how much the rate hikes will be today, because the FOMC meeting is not for another 2 weeks. So between now and 2 weeks, things are robust. Things can easily change. By the way, let me know if you guys hear me. Let me check in with you guys in the chat. Morning, Z, hola. Hassan, what's going on? Alia, what's going on? Joe, Ed, Luis, Kenny, A1 Credit, what's going on? Ayan, Mike Shu, what's going on? Lucas, Daniel, good morning. Good morning, guys, or good afternoon if you're on the other side of the world. I hear some noise, so let's see if that is.
In to verify exist.
Why is the volume so low on here?
Yeah, Ted Budd here, same thing.
They need to turn up their microphones. So it looks like they're gearing up to speak just now, but as I said, it's already there are already hints on what Jerome Powell is going to say. Rate hikes are coming. If we take a look at the Fed probability of what the interest rate hikes will be, this is the tracker based on Fed member sentiments. You can see that a 50 to 75 basis point rate hike is only targeted at 9.5%. Most of the Fed members think it will be somewhere between 25 and 50 basis points, right? So there's probably going to be a quarter basis point raise or half basis point raise, but an aggressive raise, especially during turmoil, during times of potential economic turmoil with what is going on in Ukraine and Russia, and how that is affecting the price of commodities worldwide, especially oil. It's a situation where your hands are tied. You cannot now get aggressive. And, I will talk about this in a second, because there were opportunities, I think, for the Fed to raise rates, and then COVID happened, right? Back then, President Trump was sort of pressuring Jerome Powell not to raise rates, but then COVID happened.
The committee will come to order.
All right, let's see.
Without objection, the chair is authorized to declare a recess of the committee at any time. As a reminder to all members, we will conclude today's hearing at 1 p.m. Members who were unable to ask questions at our July hearing with Chair Pro Tempore Powell will be given priority to ask.
So I'm going to mute it until Jerome Powell actually speaks, because they're going to be doing, I assume they're going to be doing, introductions and somewhat of a ceremony until then. So let's see. And I didn't even know Maxine Waters was still chairwoman. I mean, she's been, man, we got some politicians that have been around for forever. If you look at bonds this morning, if you look at bond rates this morning, you'll see that they're all up. Now, not the 10-year is well below 2. It's at 1.796. The 10-year did hit above 2. But the reason that bond rates dropped is because investors were pouring into bonds as a safe haven, right? So especially during times of volatility, the stock market and the bond market are competitors. And you're seeing liquidity being transferred out of the stock market and being poured into bonds. And the way that bonds work is when there is demand for bonds and investors start dumping money into bonds, that's when the bond rates start going down, right? So the 10-year dropped all the way from, 2% down to now below 1.8%, slightly up today. But if you guys are in the market for a home or looking to refinance a home or in the market for a car or whatever, a lot of the rates that we see in the economy, they're based off of the 10-year treasury note, right? And we're, the 10-year treasury note is now down 0.2%. So potentially you can lock in a pretty good rate if you are shopping, because I don't expect rates to be down forever, right? Especially if the Fed starts raising rates. If the Fed is going to raise rates, then bond investors are going to wait it out until they can get a better return on their money. So that's the logic there. But as we wait for Jerome Powell here, I will go over what was already discussed or telegraphed ahead of this meeting. So it says Fed Jerome Powell said Wednesday he still sees interest rate hikes ahead, though he noted implications for the U.S. economy are highly uncertain from the Ukraine war. And if you take a look at the price of oil, and this is what I was saying in the Discord yesterday, or a couple days ago, but if you take a look at the price of oil, for instance, right? Let's take a look at Brent. If we take a look at the Brent futures, you could see, the WTI futures, you could see that. Look at this gap up. It's $109 a barrel, right? And I drew this arrow here to showcase that oil has been going up all of February. And here's why that's important. Because the CPI numbers come out March 10th, right? CPI gives us an indication of inflation, which is the number one enemy of the economy right now, right? So you could see here, Russia-Ukraine conflict is a worry, but this is still the biggest threat for stock investors, which is inflation. So if you see that the price of oil has been shooting up, I can't believe it's almost 110. Actually, I can believe it. We could even get to 120, 130 a barrel, depending on what goes on with Russia. Even though yesterday in the State of the Union address, Biden said that them and a coalition of oil-producing countries were releasing 16 million barrels, which is really nothing in the long term, in order to tamp down oil prices, right? Or try and help, I guess, supply major economic powers with oil while the price of oil is skyrocketing, right? So trying to subsidize the price of oil with those 16 million barrels. So if you look at oil futures, that's up. If you look at, and I'll get to your guys' questions in a second. We won't just be focusing on Jerome Powell. I'll get to your guys' questions. If you look at lumber, it's up 35% in February, right? Look at gold, right? Gold is up. Let's see. Gold has been climbing up all of February. I don't know why TradingView is slow today when it comes to futures. That's not the right one. Let's just look at GLD. But gold has been going up all of February, right? What about wheat? Let's take a look at wheat futures, right? The price of wheat has absolutely skyrocketed. So my point is that the inflation data that look at wheat. I mean, wheat, this is insane. Wheat is up another 7.5% today, right? And I'm sure all of you guys who are in the food industry or the restaurant industry, I'm sure you could see the price of everything skyrocket. Jerome Powell's not speaking yet. I'm sure you could see the price of everything skyrocket, right? And my point is that in all of February, we're seeing the price of wheat, the price of oil, gold, the U.S. dollar, other metals, lumber, every single commodity is up insanely in February. So what are those February CPI numbers going to look like when they're released in March? Is it just going to look like mayhem? I mean, so far, based on it, just looking at those individual commodities, it looks like that is a very real possibility that the CPI numbers just come in so hot. And at that point, regardless of the geopolitical situation, I honestly think that the Fed, like if the numbers come out and we are now over 8.5% on the CPI, right? I don't think the Fed has any leeway except for to be aggressive, right? Because we will see a situation like we saw back in the 80s. I mean, if you look at this is a great article from The Balance, but it talks about the history of inflation and the Fed funds rate. we saw inflation slowly creeping up. 1980. Sorry, let's go back a little bit. So in 1978, unemployment was 6%. Inflation was 7.6%, right? They didn't really do much to tamp it down. You look at 1979, inflation went up to 11.3%. 1980, inflation went up to 13.5%. So inflation, if you don't do enough to attack it, and they were raising the rates at this point, they were raising the rates. If you look at the Fed funds rate, went from 10% to 11 to 13 to 15, all the way up to 20 in March 18th, 1980, 20% on the Fed funds rate. And that is finally what did it. That is finally what started bringing down inflation. Now, I'm not saying that this is the exact same parallel situation as 1980, but it's sort of relative, showing you that aggressive action is needed. Aggressive monetary policy action is needed to actually drop this inflation number, or else it will just keep rising. And for those that don't think double-digit inflation is something that's realistic for the U.S. and it's isolated to countries like, Venezuela or whatever. No, we saw double-digit inflation, and we could very well see double-digit inflation again as the price of everything. I just can't believe that wheat is up another 7.5%. That is just nuts. Is Jerome Powell speaking yet? Who is this clown? Mr. McHenry with the bow tie. This guy woke up and was like, you know what? I'm going to stand out today. I'm going to stand out. I'm looking for promotion. No tie, bow tie. I'm going to go bow tie. And yeah, it's going to be this candy blue and white striped bow tie. This is what this guy was thinking. He probably thought he left the house looking fresh as fuck this morning. His wife was probably like, "Oh, you look so good, baby. Yeah, that's exactly what you should wear." And he left the house thinking that, he would look like a PIMP right there in Congress. All right, let me get to your questions while we wait. All right. Let's see. 1980s inflation was because of a banking crisis caused by gold reserves being called. But yes, I mean, there are different factors, right? There are different factors. But I'm sure that people in 1980, if they saw what we were doing now with monetary policy, printing dollars to high hell, adding $9 trillion of assets on the Fed's balance sheet. I mean, I'm sure we're looking at that as a unique situation, Jonathan, and you're right. But I'm sure they're looking at our situation. They're probably looking at our situation as even more nutty, because this is something that the Fed actively did. It wasn't a circumstantial result, right? This is the Fed actually went out and enacted these policies. So yeah, you're right. But I'm sure they're looking at us as, they're looking at our time as a unique monetary event as well. So yeah, every period is different, but that's not my point, Jonathan. My point is not to sort of illustrate the exact causes of inflation for every time period. I'm just showing you how crazy inflation was and how it is actually hard to drop those inflation numbers down, to tamp down inflation if you don't act aggressively, right? That's all I'm saying. So yeah, good for companies doesn't mean good for investors. What are you talking about? And Fo Drew, what are you talking about? Not sure. Nixon took us off the gold standard. Yeah, but that was way before. But yes, I mean, yeah, sure. It all, it's all part of the puzzle. But Mad Money, stop spamming the chat, please, or else I will not answer your question. What are some things the FEE could say that will crash the market? Well, he's not going to telegraph. Jerome Powell is not going to telegraph his entire position right now, right? It's already, what was said is already here. I mean, what's likely going to be said is already telegraphed, that they will raise rates. Now, I don't know if someone will press him on how aggressive he will be in raising rates, but I guarantee you he'll say something like, oh, it's a fluid situation. It really depends on what's going on with the price of commodities, with the situation in Ukraine, whatever. I don't think you're going to get an exact answer on, how much he's going to raise rates. So, I think this is really the extent. I think this is the extent of what you will get from him. Now, what I am interested to see is he then going to bring up the balance sheet again? Is he going to bring up the balance sheet runoff again? Or is he going to remain tight-lipped on that because he knows that if he opens his mouth on that, the markets could likely lose their, we should talk about what the markets are doing right now, but the markets could likely lose their gains for the day. And the NASDAQ already did. You see the NASDAQ is down. Actually, you know what? Let me refresh this just to make sure. Yeah, NASDAQ is already down 0.17%. NASDAQ started off strong, and we are maintaining our hedges, guys. We still have our hedges open because the market is uncertain. When you look at the VIX is still climbing. The VIX was climbing today as the markets were going up, right? And for those that are new to the concept of the VIX is just the volatility index. Okay, it's slightly down now, but the VIX is just the volatility index, and it is based on S&P options, right? So that is what the VIX is based on, S&P options. So yeah. All right, let me get to your questions. He had to YouTube how to tie it. He woke up and chose Cadbury. Anfo Drews, Z, can you flex your buys for us? I'm wearing a long sleeve shirt purposely. Shauna, he does look fresh as fuck. Mixing it up. Don't hate. No, I'm not hating. I guess. Maybe it sounded like I was. I don't like McHenry, so I enjoy this rant. Leave my man alone. Hey, guys, I'm just messing with him. Looking sharp. Everything he's saying is tanking the market. What is he saying, actually? Oh, guys, you should have let me know. Jerome Powell's on.
Positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but with cases having declined sharply since mid-January, the slowdown seems to have been brief. The labor market is extremely tight. Payroll employment rose by 6.7 million in 2021, and job gains were again robust in January. The unemployment rate declined substantially over the past year and stood at 4% in January, reaching the median of FOMC participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has ticked up, labor supply remains subdued. As a result, employers are having difficulties filling job openings. An unprecedented number of workers are quitting to take new jobs, and wages are rising at their fastest pace in many years. Inflation increased sharply last year and is now running well above our longer-run objective of 2%. Demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus, and price increases are now spreading to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. The committee will continue to monitor incoming economic data and will adjust the stance of monetary policy as appropriate to manage risks that could impede the attainment of its goals. The committee's assessments will take into account a wide range of information, including labor market conditions, inflation pressures and inflation expectations, and financial and international developments. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates because of the waning effects of fiscal support and the removal of monetary policy accommodation. But we are attentive to the risks of potential further upward pressure on inflation expectations and inflation itself from a number of factors. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. As the FOMC noted in January, the Fed funds rate is our primary means of adjusting the stance of monetary policy. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. Maintaining the trust and confidence of the public is essential to our work. Last month, we finalized a comprehensive set of new ethics rules to substantially strengthen the investment restrictions on senior Federal Reserve officials. These new rules will guard against even the appearance of any conflict of interest. They are tough and best in class in government here and around the world. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Chair Pro Tempore Powell, as you know, the Fed is required to conduct monetary policy in a manner that fulfills its dual mandate to promote maximum employment and stable prices. But as you have explained, most of the inflation we're experiencing right now can be traced back to supply chain issues related to the pandemic, and the Fed cannot directly affect supply side conditions. These supply chain constraints seem likely to only significantly increase as Russia invades Ukraine and the full effect of our sanctions take hold. If the Fed's tools are mostly useful in stimulating or constraining demand, how can we expect monetary policy to rein in inflation that is largely driven by supply-side factors?
Our policies really cannot, as you point out, affect supply-side conditions. Our policies affect demand. What we're facing now is, though, an elevated level of demand in the face of supply-side constraints, and it's the collision of those two things that's creating inflation. So there is an important job for us to move away from these very highly stimulative monetary policy settings to a more normal level of rates and perhaps tighter at a time when inflation is highly elevated, and that is what the committee plans to do.
So it seems clear that the Fed has limited tools to address inflation and that Congress has an important role to play.
What?
The Monetary Policy Report notes major shortages in housing supply as a factor in high prices. If Congress were to make investments to alleviate these shortages, do you think this would be helpful in addressing inflation?
Major investments in housing supply. So I think housing prices are high for a number of reasons, actually. Difficulty in getting lots, materials, difficulty in finding workers.
I'm not even sure I understand
that
question. Congress investing
extraordinarily high. So those are
in housing supply.
Those are many of the features, and also low interest rates have made credit widely available. Mortgage rates are going up. That will probably begin to cool off demand. I wouldn't want to comment on congressional legislation, but I do think there's no doubt a role for Congress.
So I suppose I could conclude, without having you comment directly on fiscal policy, that you agree there are ways to manage inflation outside of monetary policy. It's not only monetary policy, that others have a role to play.
I do think that's right, but more in a sort of medium or longer term sense. I think the Fed does monetary policy, and inflation is largely a monetary phenomenon, and it's our tools that can be used to address inflation. Over time, though, of course, anything that expands the productive capacity of the United States over time would, in principle, make greater potential output and a less constraining economy.
Fed forecasters expect that inflation will subside as supply chain disruption issues are resolved. However, housing and rent prices, as you've said, account for roughly 1/3 of the consumer price index, and most economists do not expect the problem to be resolved as quickly as supply chain bottlenecks due to both the time it takes to develop housing and the lack of investment in housing that is affordable to low and moderate income families. Currently, there's a shortage of nearly 7 million rental homes that are affordable and available to America's lowest income renters, and a shortage of more than 5 million homes.
So the gist of what he was saying was that, basically it's an evolving situation with regards to Ukraine and Russia. Maxine Waters was asking him if there are any monetary policies that can, affect the supply side. And he's like, no, monetary policies only affect the demand side. And she seems to insinuate that really the crux of the issue is supply chain disruptions, which is not really the cause or the sole cause of inflation. Even Jerome Powell looked like he was kind of baffled by that, but he was saying, the ease of credit and the fact that rates were basically zero, and the availability of money and the availability of liquidity is also what is adding to inflation, not just supply constraints. Yes, supply constraints does play a part in that, but the Fed cannot do anything about supply constraints. However, they can do something about demand. And when you attack that side of the equation, then there will be less demand, meaning if there's less demand, then the effect of supply chain constraints will be lessened because companies won't be as pressured to scale or produce as much, right? So it really all comes down to monetary policy at the end of the day. And the fact that we did have an opportunity to raise rates before the pandemic hit, and then now our hands are tied. We cannot raise rates during a potential recession, during a pandemic, right? And then just when we're about to raise rates, what happens? The Russia-Ukraine situation happens, and now our hands are tied again. That's why, when you have nowhere to go, meaning when rates are effectively zero and you have nowhere to go, it becomes a very dangerous situation. That's why a lot of bearish economists, they're really concerned at this moment because, you are effectively at zero. The Fed funds rate is effectively zero. And so you cannot maneuver from this place. You cannot drop rates. I mean, I guess you can go negative rates like we do in some, in some European countries, but really that's not sustainable. So there's nothing you can do except for either stay at zero, which we can't do because inflation is completely, taking over. Again, we were going over the price of different futures before, but inflation is really running rampant. As you can see here, the price of wheat up 7.5% today, was up 5.5% yesterday. The day before was up 8.6%. I mean, the price of wheat is just absolutely skyrocketed. Anonymous, thank you so much for your donation to St. Jude's. So, it's you can't effectively stay at zero, but then how do you get aggressive during a time when the geopolitical landscape around the world involves two countries that are heavy producers of oil and natural gas? And you see the price of oil now almost hitting 110 today, which is unreal. I don't even remember the last time it did that. So, yeah, I mean, once again, the Fed's hands are tied. They probably should have raised rates before the pandemic, and they didn't because they wanted to keep the market going. They wanted to keep the party moving, right? So, yeah. Let's see how the markets are actually being affected by what is going on right now. All right, so we are seeing a bounce back in the markets. I mean, complete volatility here in the Nasdaq. Was up 0.5%, dropped to minus 0.5%, now up a third of a percent. So, this is all because Jerome Powell isn't really saying anything that is unexpected, right? The fact that they are going to raise rates. He did mention balance sheet runoff, but he kind of hinted at not actively selling assets off of the balance sheet, right? So Peter says he just said that he will rise 25 basis points. Okay. Is that what he said? I'm going to turn this down. I'm going to keep it going. But yeah, if he just said that he would rise here, let me see if I can get. Let's see.
Something less than that. And unlike these temporary supply-side constraints that we see, housing inflation really is much more of an indicator of the tightness of the economy rather than supply-side problems. So it's something we watch carefully along with wages, frankly, and it is a major contributor to inflation. As I mentioned, higher interest rates housing is a very interest-sensitive sector, and higher interest rates, really interest rates that move back toward a more normal level, should act to cool off the housing market over time.
Thank you. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Chairman Powell, thank you for your leadership in tumultuous times, and this is certainly interesting times internationally, challenge times internationally. Everyone else on the Open Market Committee, it seems, has opined about the March meeting. Everyone, whether it's a tweet or an interview or anything else. What are your thoughts going into the March meeting?
The March meeting. Okay, so here's how I'm thinking about the March meeting. I guess I would start, of course, with the U.S. economy, which is very strong, the labor market extremely tight, and inflation running well above target. The way we think about our work is we develop working plans for making adjustments to monetary policy over the course of the coming months, and then we are flexible as plans meet the real world. So we're never on autopilot, obviously, and at a time like this, what we aim to do is lay out our principles and then, with whatever clarity we do have, and then proceed to implement those policies carefully and nimbly. So coming into this meeting, let's say before the Ukraine invasion, the committee was set to raise our policy rate, the first of what was to be a series of raises expected for this year. Every meeting was live. Decisions would be based on incoming data and the evolving outlook. I also expected we'd make great progress on our plan to begin to shrink the balance sheet. And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. And so it's too soon to say for sure, but for now, I would say that we will proceed carefully along the lines of that plan. The thing is, the economic effects of these events are highly uncertain. So far, we've seen energy prices move up further, and those increases will move through the economy and push up headline inflation, and also they're going to weigh on spending. We're seeing effects on other commodities and perhaps from declining risk sentiment and weaker growth abroad. The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting, we'll make good progress toward an agreement on a plan to shrink the balance sheet. We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. we use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Very specific. Now, you mentioned 25 basis points. From all the analysis about what the Fed will do over the course of the next year, is 25 basis points the floor, the ceiling? Is it the speed limit? Is that the max you think the Fed could take on? How do you think of that?
So here's how I think about that. We have an expectation. Those of us on the committee have an expectation that inflation will peak and begin to come down this year. And to the extent inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings.
Now, you mentioned the balance sheet, a plan for the balance sheet, and that is to come. But what I'm hearing clearly from you is that the Fed is very interested in financial stability given what's happening, and you're willing to make quick decisions on a question of liquidity, on a question of market stability, those important works that you've focused on as Fed chair. And so this is actually substantial news for the House to be the first rather than the Senate to break news. So thank you for your forthcoming, being so forthright about your views on this. And with that, Madam Chair, I yield back.
Thank you. The gentleman from...
So you guys heard he's already projecting a 25 basis point rate hike. But obviously we have the jobs numbers coming out. We have the CPI data coming out. And you can see that the market is now skyrocketing because 25 basis points is very dovish. And basically it keeps the party going, right? So it does not mean that by the time March 16th rolls around, we will actually see only a 25 basis point rate hike. But it shows you that that's what Jerome Powell, as of now, considering all the facts that we have right now, the geopolitical landscape, the hot inflation data, that the data that we have currently up to this point, that he's only thinking of a 25 basis point rate hike. However, CPI comes out before the Fed meeting, and again, if that comes out super hot, then there won't be a choice but to raise it 50 basis points. Let's see what he says.
Developing sanctions, we are not a principal. That's really a job for the administration, particularly the Treasury Department. So we provide technical background support and things like that. But I think questions about sanctions and their effects generally would be more for the administration and the Treasury Secretary. I think you can see, I will just add, though, that the effects of the sanctions so far appear for now to have been significant.
Yeah, I mean, we saw what happened to the ruble. We saw what happened to the market. The market's still closed. Is a way around it for them cryptocurrency? Could you talk a little bit about that? I know it's a little bit out of your bailiwick, but as you said, it's an interesting moment in time. We haven't had to face this since really World War II, and even all the comments that you made about inflation and watching the market, so much of it is tied to obviously what the Russians are doing with respect to their unwarranted and
the NASDAQ is skyrocketing now, up 3/4
so
of 8%.
I don't have any private information on the extent to which that is happening, but that is something you read about and hear about. And I just think it underscores the need really for congressional action on digital finance, including cryptocurrencies. We have this burgeoning industry which has many parts to it, and there isn't in place the kind of regulatory framework that needs to be there. It was probably no different with railroads or telephones or the internet, and ultimately
he's talking about crypto
is a framework, and in particular ways to prevent these unbacked cryptocurrencies from serving as a vehicle for terrorist finance and just general criminal behavior. Tax
Come on,
avoidance and the
Jerome,
like.
not you.
So I guess that's what I would say there. I don't really know the extent to which it's happening, although you do hear that and read it in the paper.
Seems like an outform since we did go down this road. Could you comment a little bit about then the central bank digital currency? It seems like that would be something that would be helpful in situations like this.
Yes, so we issued a paper after much thought and many drafts. We issued a paper, was it late last year? I guess it was late last year, seeking public comment on the costs and benefits of a potential central bank digital currency issued by the Federal Reserve here in the United States, digital dollars. And we await, I think we gave an extended comment period, and we gave, and we very much look forward to reading those comments. This will be something that we invest a fair amount of time and expertise and hiring people and things like that to try to get it right, but also to understand whether the benefits actually outweigh the costs, which I think is an unanswered question both here and around the world. Nonetheless, it's our obligation to move vigorously to understand the answers to that question so that we can deploy a central bank digital currency if it's appropriate. So would it, in principle, it depends on why people are using unbacked digital currencies. If they're using them to evade, visibility and evade the law, then for us just to have a law-abiding CBDC won't change that. They'll still be able to use those currencies for that matter. The existing digital currencies that again are not backed are really vehicles for speculation. They're not used in payments. They're not a store of value. They're speculation like gold. That's what they're used for. Whereas, potentially a U.S. CBDC would have a wider view. I do want to stress we have not decided to do it, but we do understand our obligation is to really get to the bottom and understand both the technical and the policy issues that need to be answered.
Thank you, and I know my time's about up. I'd just say from your lips to God's ears, I hope that the inflation does peak this year and does come down because people are hurting. And thank you very much again for your steady stewardship.
Thank you very much.
Thank you.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Welcome, Chair Powell. It's good to see you in the chair. We appreciate your time and service. Chair Powell, since the last FOMC meeting in January, the global economy has become markedly more complex. Russia's unprovoked and unwarranted invasion of Ukraine has led to a very steep increase in the price of energy. As of this morning, when I checked, a barrel of crude oil was priced at $112 per barrel. And this steep increase in the price of energy risks pushing U.S. inflation potentially even higher. How does, and you've touched on it a little bit, but how does the war in Ukraine affect your thinking as you prepare for the next FOMC meeting?
So I think the first thing, again, to say is that the ultimate economic effects of the war and all of the sanctions and events yet to come are just very highly uncertain, and we need to understand that. And so, as I mentioned, I think it's appropriate for us to move ahead. Inflation is high. The committee is too high, and the committee is committed to using our tools to bring it back down to levels of price stability, which is to say 2% inflation. So, but I would also say that given the current situation, we need to move carefully, and we will. And we'll be nimble. We'll be looking at the situation as it evolves. And again, we will use our tools to add to financial stability, not to create uncertainty.
So at this point in time, you don't think that it significantly alters your expectations for the rate increases that you've discussed this year?
I don't think that's knowable yet. I mean, so we've run what we like to do is run alternative scenarios, and we've done some of that, as you would expect. And it's easy to find cases where it would affect, but we don't know that yet. We honestly don't, and we'll see.
Thank you. Chair Powell, could you explain the role of the Federal Reserve in implementing U.S. sanctions on Russia? How you're working with OFAC? How
that's not the Federal Reserve's job.
So sanctions are really designed by the administration. They're part of what the elected government does, where we provide technical support. We implement those sanctions, or we make sure that the banks obey them, that we supervise and regulate. That's one thing that we do. We also consult on. We have knowledge about financial markets and financial institutions, so we're providing technical support, but we're not the decision makers on those things. And honestly, these are decisions that are made at the level of the government, not at the level of the elected government, not at the level of the Fed.
And I know things are happening quickly and in real time here, but what actions has the Fed taken to date since the invasion of Ukraine?
Guys, hit that thumbs up if you're on the live stream.
I'd say,
it
first
goes
of
a
all,
long way.
since late last year, we've been on very high alert for cyber attacks. We haven't seen any notable incidents about that yet. We consult. We're making sure that the banks we regulate and supervise are also on high alert. We communicate with the reserve banks where there's a lot of expertise in these areas and other parts of the government. So that's one thing that we've done. We're, as I mentioned, we are in very close contact with the Treasury Department, as you would expect, between every central bank and every finance ministry around the world. But again, we're not the ones who designed the sanctions.
Right. Well, cybersecurity is.
All right. I just want to say a couple of things. So there is a. Yeah. All right. So now that Jerome Powell has telegraphed, right, that we are signaling only a 25 basis point rate hike, potentially. Obviously, things are fluid and it's not written in stone. But now imagine what happens when the Fed meeting rolls around and they announce a 50 basis point rate hike, right? Imagine what happens then. There is where is that? Right here. So this right here, this chart is from a user called Mr. Blonde on Twitter, but basically showing what happened the last time we had a tightening tantrum, showing the S&P 500 from March 2018 to January 2019 and what happened after the FOMC meeting. We did have this bounce back in the S&P 500, sort of like we will likely see in the markets now, right? You are seeing somewhat of a bounce back. There's questions here on the on the YouTube, on the chat, saying, oh, why is the market going up? Why is the market going up? Well, because he said 0.25% rate hike. That is the least that they could do, right? The most dovish, the most passive approach, other than not raising rates, which again he's not going to do. So, if you are going to raise rates, the smallest step that you could take is a 25 basis point rate hike, and that's what he telegraphed today. So you're seeing a temporary push up in the markets. However, the backdrop of inflation is still there, and it is still a large unknown. We don't know how bad inflation is going to get. And if you're joining this stream late, I went over the price of oil, the US dollar, the price of wheat, the price of lumber, the price of metals. All of that has shot up drastically in February. So that CPI print coming out on March 10th potentially is going to look really violent, right? And if that's the case, then I think the Fed will now have to raise rates beyond the 25 basis point rate hike and will likely target the upper end at that 50%, or sorry, that 0.5%. I don't think we're going to get higher than 0.5% on the first rate hike. But back here, we saw that the same thing occur the last time that the Fed, right after the Fed meeting. In this case, they were talking about a balance sheet runoff during 2019, right? So, yeah, I mean, if the point is, if inflation comes in hot, and then during the Fed meeting, they surprise everybody with a 0.5% rate hike as opposed to the 0.25 that he's talking about here, the markets could actually tank, because now that is unexpected information. Now the market is rallying due to the fact that we are expecting the lowest bar possible, which is a 0.25% rate hike. Hopefully that makes sense. Do you guys have any questions? Do you guys want me to go over anything? By the way, hit that thumbs up if you are still on the live stream. There's quite a few people here, so definitely hit that thumbs up because it allows other people to find the stream. But yeah, I mean, telegraphing your position now without really knowing how bad inflation can get, and then potentially having to go above and beyond what you just telegraphed, that will likely cause somewhat of a short-term shock to the market. I'm not sure what he's talking about right now. Let's see.
There's chatter, Mr. Chairman, public chatter, that the intensity of the inflation that we're dealing with today is a reflection of the Fed not taking policy action soon enough, not taking enough policy action. And there's chatter, public chatter, that causes the Fed's credibility to come into question as to whether or not it is acting responsibly and appropriately with the data sets that are coming in. And I bring this up, Mr. Chairman, because we have a duty to the American people
Fair
to
question.
be able
Fair
to
question.
raise these questions as pointed as they are, and to give individuals such as yourself an opportunity to really speak to the credibility question that's really out there in the community. If you could elaborate further on that.
Sure. It's for others to judge many of the things you mentioned, and we understand that. But so we, starting in December, at our December meeting, we began talking about significantly more rate increases. The market took us very much at our word, and as this year has gone on, the market has so market participants do appear to be reacting, what I would call as appropriately to our assessment, our ongoing assessment and reassessment of what's appropriate. And I'll just assure you and everyone that we are committed to achieving price stability. We will use our tools to achieve price stability. Really, that is an essential bedrock element of everything else we want to achieve in the economy, including a strong labor market.
When we faced the financial crisis in 2008, a lot of lessons were learned about the need for the Fed to be more responsive to the liquidity traps that could take us by surprise. Given the circumstances we're dealing with today and the frustrations that the American people are facing, can you share with us any lessons that the Fed has learned with respect to its responsiveness to the inflation that we've been dealing with over the past 12 to 18 months and the intense inflation that we're dealing with today?
So the inflation that we're experiencing is just nothing like anything we've experienced in decades. It's higher, of course, much higher than anything we've seen since I was much younger. But not only that, it's different. It's coming from the goods sector. The goods sector has been a source of disinflation for a quarter of a century because so many manufactured goods have been
But just specifically, Mr. Chairman, reclaiming my time, what specific lessons has the Fed learned from the outcome that we're dealing with today?
Well, I mean, we're still living through it. So the main focus we have is not on doing a retrospective. It's on conducting policy appropriately to return us to price stability while also sustaining the expansion.
Gentleman's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, thank you for being here, and congratulations on your nomination to continue your job for a second term. I think it's well-deserved. Before I get to my questions, though, I want to hold up something here. This is a Ukrainian dollar. It's a hryvnia. I kept some of these when I was in Ukraine several years ago doing some ministry work, and I think it's interesting to think that what happens in the next few days may determine whether this is another defunct piece of currency and the nation returns to a ruble, or will this maintain some of its value? But as you look at it, you can see it's a fraction, physically a fraction the size of the U.S. dollar. It takes about 30 of these hryvnias to match a U.S. dollar, but when you look at values, our dollar has decreased in value, as you have mentioned, due to inflation. Now, a year ago when you testified before this committee, I asked what your outlook was for the economy, and you said you expected economic growth to be strong for the rest of 2021. But at that time, I warned that the $2 trillion stimulus bill that was making its way through Congress at that time was unnecessary and far too big, given the economy was already recovering. Lo and behold, these predictions came true. In your opening statement, you mentioned that you didn't expect inflation to continue at the rate it is right now, but I also recall throughout 2021, we heard that inflation was slight, it was going to be temporary, but I also understand that that prediction probably didn't include the actions and the roles that Congress had, as you had said. Now, according to a report from the Federal Reserve Bank of San Francisco, because the American Rescue Plan was so extremely large and was passed when the economy was already recovering, this was a significant contributing factor to inflation. Do you agree with that report from San Francisco's bank that our reckless spending is a contributing factor to our inflation?
I wouldn't like to comment on any particular law, but I'll say this. All of the things that we did after the pandemic were we turned our dials as hard as we could. So did you, with the CARES Act. And the economy did benefit from that. We have the strongest economy in the world now.
He's straight up dissing politicians.
But, part of that, no doubt part of what we did and what Congress did without naming any particular laws is also part of the reason why inflation is high now.
Right. So there are multiple contributing factors to that, being reckless spending, which devalues our dollar, is one of those.
Jerome
and what we
Powell
heard
is a
last
gangster,
night
by
was
the way.
that there is not going to be a change in the direction this Congress is going or the White House. It sounds like we're just going to repeat the same mistakes we made in 2021. Now, I know that you have the tools of adjusting the interest rate. You mentioned increasing 25 base points, and you mentioned that it may be necessary to go higher. Understand that. Do you still think that inflation will be temporary? And I believe that you said it would be short-lived going forward because of
He used the word
resolving our
transitory.
supply
How does
chain
Louder
issues.
Milk not know
But
this?
since there are other contributing factors to that, are you anticipating that Congress or the administration will undo some of the failed policies, such as the spending policies and the suppressing of America's energy supply, which has been a significant contributing factor? Let me rephrase that. If Congress and the White House does not change the policies of 2021 and continues down that same path, do you still believe that inflation will stabilize? Price stabilization will come this year? Well,
First, we've had this expectation, as you all know, for more than a year, and it hasn't actually come true. So we're humble about the fact that we can't really call with any confidence the turn.
But why would they expect inflation to go down? Based on what?
Withdrawing policy accommodation. Actually, a lot of the fiscal policy spending has happened now, and so the impetus to growth will be declining and, in fact, negative from fiscal policy as it stands now. And those are things, and just the natural improvement of supply chains and labor supply and things like that. Those are the things we're looking to for relief on inflation, hoping for. Very difficult to say when they'll happen, and our job is to achieve price stability one way or the other.
Okay. I see I'm running out of time. I've got several other questions, but I'll submit those.
Jerome Powell is so gangster because this Louder Milk guy basically told him, he said, he mentioned, he used the word, I think, reckless, but he was like, basically, do you think that the Fed's reckless policy contributed to the type of inflation that we see now? And he said, because of the pandemic and the threat of recession, we turned our dials all the way up. And he said, but then so did you guys. And he's pointing it back at the lawmakers because they obviously passed stimulus, right? The Fed doesn't pass stimulus. The lawmakers do. So it was like, it reminds me of like a sort of like a rap battle, but he was like, yeah, you guys did shit too. It wasn't just us, motherfucker. Right? Shit was hilarious.
Been driven by bottlenecks in the supply chain. And
Jesus, this guy's microphone is terrible.
Their role in corporate concentration and price increases. I'll note that CEOs from Kimberly-Clark to Tyson Foods have bragged to investors about their power to raise prices without facing.
Yes, Led Zepp. We'll talk about the wage spiral. The wage price spiral is a real thing, right? Two things that I'm worried about: demand destruction, which I've been talking about for months, and a wage price spiral. So I will talk about that after this testimony.
Last time it was because my neighbors lost their jobs and couldn't find diapers or chicken. So is that the idea?
Well, the idea is that right now the federal funds rate is still set close to zero. and that is a very stimulative level. I think it's 8 basis points today. So that is not an appropriate level, we think, going forward. We think it's appropriate that we engage in a series of rate increases over the course of this year and also let our balance sheet shrink. And so what will happen then over time is demand will moderate as interest rates get into the economy over time, and these annual price increases in everything where prices are going up will moderate as well. That is how it has always worked with interest rates. We don't do competition policy, so I can't really comment on that part of it. But I will say that that's how we think about inflation, and that's how we use our tools to get inflation under control.
Changing gears, we discussed corporate concentration, and last July, the president issued an executive order on competition that encouraged the Fed and other regulators to increase scrutiny of bank mergers. It's been a long time since regulators blocked a bank merger, even an acquisition by a globally systemically important bank, or GSIB, in 2020. Chairman Powell, do you think it's appropriate to issue a moratorium on pending mergers while the Fed updates its framework for their review?
Well, I think we have a statute that Congress has passed that gives us the rules for evaluating potential acquisitions and mergers by banks. I think we have a widely developed framework for that work, and we're continuing to implement that. I mean, any changes that would come would either come through legislation or through new personnel at the Fed, neither of which we have right now.
As we learned from Wells Fargo, frontline bank workers are an important resource for regulators.
All right, so I wanted to talk real quick about the wage price spiral, right? Because I see a couple of you guys mention it here. And I'll go back to Jerome Powell's testimony once he starts talking about something new, because right now he's just repeating himself based on the representatives' questions. But the wage price spiral is something real and could lead to stagflation, right? So there's really two things that I'm worried about that could lead to stagflation. There's the wage price spiral and then demand destruction. But basically the wage price spiral is a cycle, right? A violent cycle by which rising wages, which we have now, I think wages are up almost 9%, 8 something, right? Creates rising prices and vice versa. So as wages go up, prices go up, wages go up, prices go up, and that leads to really deteriorating economic growth and potentially an economic slowdown. So that is definitely a possibility based on the economic conditions that we see now, right? And then demand destruction is the other one. And demand destruction is dangerous because demand destruction is a permanent downshift in the demand curve. And it is really induced by two things: a prolonged period of high prices and constrained supply. Two things which are probably worse now than ever before, right? This is certainly the worst inflation that we've seen in 40 years. And the constrained supply, like the demand is so high and prices are so high that it's causing supply chain disruptions. That cannot last a long time without denting the demand curve. And if you dent the demand curve, you do see a slowdown in economic growth. So you have the wage price spiral where wages are going up, but also prices are going up and supply chains are being constrained. And all of that can lead to stagflation, right? Which is basically a slowdown of economic growth due to and simultaneously seeing an increase in prices and an increase in wages, which will then lead to a slowdown in hiring, right? So this is definitely a very real phenomenon that could happen that we saw back in the 70s and coincides with what I was talking about. If you look at the late 70s, where unemployment started rising with inflation going out of control, right? So yeah, you see here in 1978, unemployment was 6%, inflation was 7.6%. Inflation went up to 11.3%. Unemployment started ticking higher as well. Inflation ticking higher as well. So, you know, it was year after year, we saw an increase in unemployment, an increase in inflation that caused the federal funds rate to hit that 20% mark that we saw back in 1981, because Paul Volcker was a gangster and knew how to tamp down. So, yeah, let's see what these guys have to say.
Talking about the new CPI number, he said, I don't care what the number is, because I know that I'm paying 50% more in gas than I did 12 and 18 months ago. I know I'm paying 20 to 25% more in grocery prices than I did a year ago. I know what the price of a new car and a used car is. If you were me, if you were a member of Congress, what would you tell your constituents about the rising cost, the expensive cost to just live today?
Inflation is too high. We understand that, and you know, we're working on it. It's going to take some time, but we're going to get it back under control. By the way, we're seeing this everywhere in the world. We're seeing it more in the United States because our economy is stronger, but we're seeing it everywhere in the world.
Let me, if I can, follow up on a few questions.
Guys, hit that thumbs up if you were on the stream. It allows people to find this more easily. So please do me that favor if you're still on the live stream.
And your plans for the next Fed meeting, and I think you eloquently laid it out. But you also talked about the situation that's developed in Russia and Ukraine. My inference from your answer is that if Russia had not invaded Ukraine, that the Fed would be more aggressive as it relates to the balance sheet and to rate hikes. Is that a proper inference?
No, I think that remains to be seen. As I said, we are moving ahead at this meeting. It would be my expectation in 2 weeks with a rate increase, and we're going to make progress on agreeing on a plan at this meeting to shrink the balance sheet, and I'm confident we will. The question of when we implement that plan is not answered yet, so I don't think that's clear at this point. It's certainly something that we can't answer now.
Mr. Garcia referenced the President's State of the Union remarks last night. The President, when he talked about addressing inflation, said that we need to control cost. Did you hear him say that?
I did not. I was too busy getting ready for this hearing. I did not watch.
I won't tell the President.
I probably just
when the President said he wants to control cost, or that businesses should control cost to address inflation, would you have any idea what he's talking about?
I really can't comment.
Fair enough. In follow-up to my questions from Congresswoman Wagner, she asked you about cyber. I know pre-pandemic, pre-invasion, one thing that you talked about that kept you up at night was a cyber attack. If Russia were to retaliate against the United States in some form of a cyber attack, what degree of confidence do you have in our nation's banks to thwart a cyber attack from Russia?
What I can tell you is that everything that we can do to protect ourselves against cyber, we're doing it. You know, we're doing it. The private, large financial institutions are doing it. They have been for some time. So, it's very hard to say what's possible to happen. But we're certainly on high alert, and we will continue to be.
Thank you very much. The gentleman's time has expired. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Put it on, please. Thank you. Thank you very much, Chair.
You'd think with the salaries and the insider trading money that these people make that they would afford better mics. I mean, Jesus Christ.
Economically, from the COVID pandemic, and we're facing challenges at home and now in Ukraine, I think and I feel deeply that the Fed should not be subjected to political stunts in the Senate with boycotts by the Republicans, and the Senate should consider the pending Fed board nominations as soon as possible. The Fed has an important job to do, and President Biden has put forward qualified nominees, and we need to get this done. So that's just my main point. With that said, as you and I have discussed in the past, the economic recovery has not been even, and we still have a ways to go to ensure our economy works for everyone. Just as one example, the black unemployment rate remains at nearly 7%, which is more than double the white unemployment rate. And later today, the Select Subcommittee on Corona Crisis is having a hearing where we will be looking at the depth of the pandemic's impacts on child care providers and workers and the results that has on our families and our economies. So I want to ask you about the monetary policy report the Fed released on Friday. The Fed notes that the labor force participation rate remains well below estimates of its longer run trend as a result of retirement and people out of the labor force and engaged in caregiving activities. From both a macro perspective and a micro perspective, what does this drop in labor force participation mean for the U.S. economy, and what does it mean for those workers who leave the workforce to care for their children or family members?
Well, having a lower labor force.
All right. Yeah, looking at the markets right now, you can see that the markets are, again, it's still volatile, but they are largely green today. I said yesterday after listening to the State of the Union address that, especially with regards to what's going on in Ukraine and Russia, that we will likely see a green day in the market because the whole country rallies behind sort of the banging war drums. And although we're not going to war, really like a hot war, it still remains a geopolitical conflict, right? So, that along with the fact that Jerome Powell is now being as dovish as can be, as I said before, when you're working with an effectively zero federal funds rate, there's nowhere to go except up. And he chose the smallest step possible, signaling a 0.25% rate hike. But again, it all depends on the inflation numbers that come out on March 10th. If those come in just absolutely insane, then he will have no choice but to raise it by more than 0.25%. And you could see the NASDAQ is up 1%, S&P is up 1.52%, the Dow's up 1.6%. The Dow is the industrial average, and likely that is seeing the most benefit today because of the State of the Union address, where, Biden was talking about manufacturing. He even mentioned Intel here, right? He said Intel's plans for new factories in Central Ohio, up to 8 state-of-the-art factories in one place, 10,000 new jobs, and you can see the price of Intel going up. Intel was one of the stocks. You guys keep asking me what stocks am I looking to buy during this environment. Obviously, I'm being very picky and choosy about the stocks that I buy, considering the environment that we're currently in, but Intel is one of those stocks that I love I loved at that $44, $45 support level, especially knowing that we do have 2 fabs. I don't know about 8, but we definitely have 2 fabs or fabrication plants that are looking to be developed by 2025. So not only does that increase jobs, but clearly the government is using Intel as a conduit to get ahead of the rest of the world as it relates to chips and semiconductors, right? So, Intel is one of the companies that they mentioned, and Ford, I think, was another one. And you could see Ford's price actually going up today as well. They announced that they were spinning off their EV sector. So they are in plans to spin off the EV sector and fund that separately. It's still going to be under the Ford umbrella, but you can see Ford up 6% today. Not really anything too drastic. It's still trading within the range. And then at the State of the Union address, they did mention EVs heavily as part of infrastructure, saying that they're going to, I can't remember how many new charging stations. I think it was 500,000 new charging stations that were looking to be built. Yeah, here we go. The bipartisan legislation approved by Congress ended up providing just half of the $15 billion that Biden had envisioned to fulfill a campaign promise of 500,000 charging stations by 2030. Currently, there are over 100,000 EV outlets in the U.S., and you could see, actually Tesla was up earlier today to 880, back down to 853. So seeing some volatility in EVs. There was a little bit of a spike due to the commentary yesterday, but yeah, rather muted. I wonder what's going on with the rest of the EVs, like where NIO's at. I haven't checked many prices this morning because I've been on this live. So I did send out the day trade watch list. But other than that, yeah. And the day trade watch list is probably, let me see, probably the call side of the day trade watch list is on fire. Yeah, because we had the Qs above 345, we had the SPY above 434, and I bet you both of those are above those right now. Let me see. So if we go to the Qs, again, I haven't checked this. So yeah, we are over 345 on the Qs, and the SPY is 437. Right. So I had it. Yeah. So those that bought the 435 calls banked heavily. I had it at 434.20. That was my level, meaning that if the SPY gets above 434.20, we buy the 435 call. And right now, those are deep in the money as the SPY is at 437, up 1.65%. And by the way, if you guys want access to this, link is in the description below. And if you want an explanation of how to trade this, I did a video where you will see it pinned to the top of this this message board. You'll see that I did a whole video explaining how to read this and how to trade this from a charting perspective. So why are stocks rallying now? Well, I just told you, because Jerome Powell came out and said that they're only looking at a 0.25% basis point rate hike, right? That and the fact that we had the State of Union yesterday, where that is, especially during times of conflict, that is seen as a bipartisan event that rallies the country, and there's a bunch of enthusiasm, and everyone agrees really on the approach that the White House is taking with regards to Russia and Ukraine. Basically, no hot war, but keep pushing on the sanctions. Keep securing the NATO countries with troops and ammunitions and whatnot. So, yeah. Let's see what Uncle Jerome has to say right now.
Pass through into gas prices, into lower economic activity, and into inflation, headline inflation. And, the larger the increase, the larger the effect. But the question then will become, that's a price level change. Is that going to lead to repeated inflation increases at that time? And that is not necessarily the case. And, of course, we would use our tools to make sure that it's not the case.
And, of course, representing the constituency I do, which is both oil and gas and production agriculture, we take very careful note of what those actions will affect, how they will affect world crude oil prices. And, of course, the Ukraine being a very historic major grain producer, my wheat people also are prepared to step up and match that. But it all underscores, I suppose, the increase in energy production in the United States and supporting policies that will not penalize or drive capital away from domestic oil and gas production. That's more of an editorial on my part, Mr. Chairman, but I note that we stand ready in this country to replace resources that may not be available or affordable for the rest of the world, and we just need a little incentive and encouragement from this side of the room to utilize those things. So my last question in the time I have remaining, the economy is currently operating in what I think we'd all describe as, at the very least, massive economic uncertainty. And when you deal with this 40-year inflation and the supply chain issues and the COVID-related issues, hopefully as we're in that final stage, can you elaborate on how...
Hyder, yeah, I'll go over my trading view setup after this. Okay, let's just see what Jerome Powell has to say. If it's not that important, then I'll go over my charts.
I would say our markets have been functioning well. There's a great deal of liquidity out there. We have now, between our swap lines and our repo facility for other foreign central banks and our standing repo facility in the Treasury market, we have institutionalized liquidity provision. And I think just the knowledge that that is there will help support good market function, which, despite all this volatility, we still have.
Thank you, Mr. Chairman. I yield back, Madam Chair.
Thank you. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Warder. Chairman Powell, thank you for being here today. Given what you said about the upcoming meeting in March and the illegal invasion of Ukraine, how is the Fed coordinating with other central banks around the world and accounting for their actions when considering adjustment to interest rate policy here at home?
So we're in ongoing contact, it's fair to say, with our major central bank colleagues, and actually we have a meeting of all of them on Monday morning at 7, a virtual meeting at 7 a.m. on Monday. So it's something that we do regularly. That said, we conduct monetary policy to achieve domestic objectives, specifically here in the United States, maximum employment and price stability, and that's what we use our tools for. But it's of course the foreign events are very much top of mind right now, and it's enormously helpful to understand the perspectives, particularly of the Europeans who are so much closer physically to what's going on. So that's an important channel for us.
Thank you. And Chair Powell, last week the Fed published its 2022 Small Business Credit Survey. Among other things, the report found that small business applicants that used online lenders for their funds.
All right, so someone had asked me about going over the indicators that I have on TradingView. Yeah, I'd be happy to do that. So obviously, here, let me pull up what I usually have. So I have the moving averages, right? That is in the form of the 50, the 100, 200, and 300 moving averages. So I have it color-coded sort of in this way. Any chart that I use, I've always been doing this. You can color-code them the way that you want. We are seeing a death cross, by the way, between the 50 and the 100-day moving average on the SPY. So I'll be very interested to see if this bounce is sustainable here. We're still sitting at the 300-day moving average. I do think this is a buy point on the indices for the very long term. Doesn't mean you go crazy here, but I think that anytime the indices get to the 300-day moving average, they are a buy point. I have the RSI here, the MACD below that. And then below this, I have what's called the squeeze indicator or the TTM squeeze indicator, basically trying to determine whether something is in a sideways or consolidating activity, or if we are squeezing to the upside or the downside, right? So currently when you see, like if you go all the way back to, let's say, actually I don't see it on the TTM squeeze indicator is different on Thinkorswim, but basically when you see this, the flatter that this is, regardless of whether it's red or green, the higher the probability that the stock is consolidating, right? When you see it squeezed to the downside to red, that means that likely there will be a continuation of the downtrend, right? So right now we are seeing this peaking. We're not seeing, it looks like for all intents and purposes, this is going to retract back in, and we will likely see some sideways trading for a while, at least based on what the squeeze indicator is saying, right? But that's basically how I have my chart set up. And then I use a combination of Fibonacci levels, right? So I use the Fibonacci retracements when I need to, trying to figure out, where we might see some support or resistance. So I draw these on the chart manually. And then there are a few other things that I use if I'm trying to get a clearer picture of what's going on from a macro level, from a high level, right? This is very different from the chart that I use when I'm day trading, which you guys have seen in previous videos. I day trade on Thinkorswim. I don't use TradingView for day trading. I day trade right on the platform. So yeah, hopefully that helps. If you have questions, let me know.
Exposure that our banks have directly to Russia, and given the existing tools we have to provide liquidity, I don't see that as a likely outcome.
Okay. Thank you. I yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. Chairman Powell, thank you for taking time to not only join us today, but your insight into monetary policy. The monetary policy report of February 25th, seemingly still hot off the press, brings about, I think, a good review of the Fed's analysis of where we are. And I know there's that temptation by members of Congress to hold you accountable for things which are not within your purview, but on page...
I think he's talking about the closed door meeting.
Page 3 of your February 25th, 2022 monetary report. Special topics, low labor supply. Next, it goes to several other issues, then supply bottlenecks. As a member of Congress from Texas, both of these are highlighted to me on a daily basis as I receive feedback. This is inflationary also. We have taken a bit of time with you to probe with you your ideas that I think you have professionally handled on behalf of yourself and the Fed, the issues related to energy. But the bottom line is we can't get people back at work. We find that turns into a low labor supply, and then we've got bottlenecks. These are all hand in hand, glove in glove together, in my opinion. I took a few minutes just now to look at the labor unions and schools, teachers unions. But let's move to the federal government. Where is the federal government on their employees coming back to work now by OPM?
I don't know. We're an independent agency. I'll tell you where we are, we're in the middle of that process. Probably closer to the beginning than the middle.
I know you are, but you see, if they don't come to work, then others don't come to work. So I think your point and my point is well made.
How the fuck is that Jerome Powell's problem?
I believe that what we need is your robustness, not just your acumen in these issues, and your robustness within the administration to actually let them know that for this report, monetary policy, to be correct, that you believe inflation is a short-term, meaningful hindrance on our economy. They're going to have to make, meaning the White House, policy. They're going to have to understand what caused this. And I think that this administration, I think the Democratic Party, I think this Congress has made friends with inflation to encourage it. And that if your prognostication is going to come forth that we end this inflation, we're going to have serious changes. Because right now in Texas, which has been relatively open, I don't see relief on the horizon. And I think that this administration, this Congress, has a lot to do with it. So without chastising you, I meant to help you. I would like for your voice in this administration and within halls of Congress, perhaps doors that are shut, for them to understand that they...
Hey, Okchaz, how much did you make off of those calls? 30%? Are you talking about the spy calls?
Or whether it be with open...
Unfortunately, I couldn't day trade because I'm doing this live stream, but I wish I could.
Down the amount of money that is put in the economy. As that moves, it's going to have to correspondingly have people that come to work, that pay taxes, that move the economy. GDP as a term we used earlier today. It's shifting this big, massive task. So you've almost got a whole 30 seconds left. But I'd like to, without defending yourself, to say to you, I'd like for your voice of reason, of prosperity.
I agree, Adam. Sessions needs to pass the baton. He took like 10 minutes asking that question. I don't even know what he asked.
I support you. I'm for you. How can we help you?
I do think honestly, we have the tools and we have to use them we will use them to get inflation under control. But to the extent we get help from the supply side, it'll make that job so much easier. It's about labor force supply. It's really about supply constraints and shortages and that kind of thing. It's also about exogenous events like a war, which will drive up the price of oil and gas, and that'll get into prices, certainly, and we'll make sure that it doesn't provoke a cycle of inflation.
This is what happens when you have to rely on other people for your food, cheese, and energy. Thank you very much, Mr. Chairman.
Thank you, Mr. Sessions. You can help Mr. Powell by asking your friends on the Senate side to confirm his appointment. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Chairman Powell, how are you?
Fine, thank you. How are you, Mr. Scott?
I want to sound the alarm here this morning. And I want you to listen to me, and I want the nation to, because I'm the chairman of our House Agriculture Committee. And I'm very worried about this turmoil over in Ukraine and Russia's violent, illegal, and criminal action that they're taking, and the impact that this has on global trade, and most importantly, our own food security. We could very well be.
All right, so sorry, I'm going to shut this guy up real quick because just breaking news coming in that where did I? So I just spotted a breaking news. I'm not sure why the title of the article changed, but there's a breaking news article that says that Russia is ready to resume talks with Ukraine. Right here, it says a Kremlin spokesperson said a Russian delegation will be prepared Wednesday evening, which is tonight, and it is already, afternoon, close to evening time there, to speak with Ukrainian officials about the war. So this, along with the fact that so three things are driving the market up today, in my view. This, along with the State of the Union address yesterday, and then obviously the extremely dovish position that Jerome Powell signals. He signaled a 25 basis point rate hike, which is the absolute minimum that the Fed can do, right? As opposed to, other than keeping the rates at zero, which they're not going to do. So this right here, the market is rejoicing at this, because remember that the higher the interest rates are, the worse that is for stocks, especially mega cap growth stocks. And why is that? And if you guys want me to explain this further, I'm happy to. But basically, growth stocks require growth in order to keep trading at these multiples, right? So stocks don't trade at their book value. They trade at a multiple because the stock market is forward looking and you are expecting these stocks to grow, right? If interest rates are high, then that means the cost of money goes up, the cost of borrowing money goes up, and that diminishes the value of future cash flows today, right? So if you're expecting interest rates to go up, that means that the value of that money is going to be worth less based on the fact that interest rates are higher and the cost to producing that money goes up. That is why you see growth stocks initially tend to tank when interest rates go up. However, over time, if they continue to grow at a steady pace that outpaces the cost of money, then those stocks continue to go up. So historically, the shock to the market with interest rates rising is really a short-term and sudden effect. But if the stock market is healthy and the economy is healthy and these companies continue to report record earnings, as we saw with Google, Microsoft, Apple, et cetera, just absolute record earnings, then eventually they can overrule the effects that any interest rate hikes have. But that is why we are seeing now yet a further increase in the stock market today, is because of the fact that Powell is signaling really the most benign monetary policy that he could enact, along with the fact that we are now getting word that a Kremlin spokesman is saying that Russians and Ukrainians will likely meet tonight about the war. And if we can get a ceasefire and come to some sort of agreement, then I think the market will see temporary relief until that March 10th CPI reading, which might not look pretty, guys. It might not look pretty. And the reason is, and I went over this earlier in the stream, but the reason is if you look at the price of lumber, if you look at the price of wheat, it's just unsustainable, right? Like lumber now up even more since I started talking. Lumber's up almost 4% today. We're up 40% on lumber for the month of February alone. 40% up in lumber for the month of February alone. If you look at wheat futures, right? Wheat futures, sorry, TradingView's acting a bit slow. My bad. Doesn't do well when you have a zillion things running, even though my computer is a powerhouse. But if you look at wheat futures, I mean, just in February alone, wheat futures are up. Let me pull out the price tool here, the trusty price tool. Where is it? Price range. If you look at just for the month of February, you will see that wheat alone is up also almost 40%. So what the hell is that CPI print going to look like for February? It might be so scary. Who knows? I mean, I'm hoping that's not the case, but I just don't see how it isn't with the price of, like, if CPI hit for the month of January, if we hit that 7.5% mark with a lot of these futures trading sideways, what is it going to look like with the price of all these commodities actually skyrocketing, right? Let's see. I mean, we by the time that Fed meeting rolls around and we get that CPI print on March 10th, it might be time for a 50 basis point rate hike. So, yeah. Let's see. Let me get to your guys' questions, and then I will get back to Uncle Jerome. All right. This dude sounds sauced. Me? Or hopefully you're talking about one of the politicians. If he's that old that both his statements and thoughts are not clear, why won't he just retire? All right. Nothing really of substance here. I guess you guys are talking about one of the politicians. All right. Do you think bond prices will drop more with such a low rate hike? I will get to that in a second. Let me hear what Uncle Jerome has to say.
The balance sheet to, a size relative to our economy that it was before. So, also that is not at all our intention. We purchase longer-term securities in order to drive down longer-term interest rates to support economic activity. I'd also say that that's not really what we think of as the source of inflation. Proclaiming that inflation is far too high and that we are committed to using our tools to get it back down. It's really about very, very high demand, particularly in the goods sector, related to a spending shift that happened in the pandemic, and supply constraints that we didn't foresee. International supply chains, labor constraints, low labor force participation, right across the economy. It's a very different kind of inflation story than we've had in the past, but it's one that we have to deal with, and we will deal with it.
Guys, if you're on the stream, hit that thumbs up. That allows other people to find the stream. Unfortunately, that's how the algorithm works. So if you're on the stream, just tap that thumbs up.
Collecting data and employing stress tests related to climate change.
Jesus Christ with the mics.
The Federal Reserve would be collecting the information to help financial institutions learn about climate risk and wouldn't be using the information for regulatory purposes.
All right, so let me talk a little bit, since this is, at the end of the day, a trading channel. Let me talk a little bit about the stocks, some of the stocks that we did pick up on this dip. Like I said, we were being very choosy about what we select. Intel was definitely on that list at around the 44 to 45 range. Even before Intel announced that they were building at least 2 new fabs in Ohio, this right here is a support level for Intel, and it is rather volatile. But buying at this level, I'm okay buying and holding in the low 40s, 100%. Google right now, to me, or Alphabet, is the most undervalued tech stock. Google absolutely killed earnings, had the best quarter ever, and is trading at its lowest PE ratio since the March 2020 pandemic crash, right? So, and remember, it has a 20-for-1 stock split coming up. And as we see with mega caps, always, without fail, mega caps trade higher after a split than they do before, right? And it's creating this nice double bottom here. So we picked up Google when it hit the 300-day moving average a week or two ago, right? So Google is one that I'm very intent on owning here. One of the mega caps that I'm excited to buy. Again, trading at a historically low PE ratio at the moment. It's super discounted in my opinion. Go back and watch the last video I did, the top 4 stocks to buy for March 2022, and you'll see what I'm talking about. I did a whole breakdown on Google. Also, SPY-V, a value ETF, right? This right here off of the 300-day moving average, off of historic support levels. To me, this is an index that I want to own through a period of high inflation and high interest rates, because value stocks are doing much better than growth stocks. If you see here how stable SPY-V is compared to the regular S&P 500, and that is because this is comprised of only the value stocks in the S&P 500 and not the growth stocks in the S&P 500, right? Remember that growth stocks are the ones that take a hit during high inflationary and high interest rate environments. So SPY-V was on that list as well. Obviously, the regular indices, the Qs, the SPY, those are good pickups for the long term, in my view. Anytime they get to the 300-day moving average, I pick those up for the long term. These are not swing trades. These are long-term holds. And then you want to look at other value plays, right? Whether we're talking about McDonald's or Coca-Cola or Nike, those types of stocks, if we can catch them on the downtrend, if we can catch them at support, those tend to do well. And you want to look at stocks that also pay dividends, right? Because dividends help, any little bit helps to combat the inflation that we will likely see for the rest of 2022, right? So if a stock pays a 5% dividend, the other stock that I was looking at the other day, Foot Locker, this is definitely one that I eventually want to get into. So Foot Locker tanked on absolutely crushing earnings, but they did provide a little bit of a muted guidance. And it is back now. It was back below 30 yesterday, and its dividend yield is around 5.5% to 6%. So Foot Locker in the 20s is definitely one that I'm interested, a value stock that I'm interested in picking up. Earlier last year, Foot Locker was trading in the 60s, right? So happy to pick it up in the 20s. Haven't made a huge buy here because I want to see if we do find support after this gap down. I think we do have some time, but Foot Locker is definitely on the list. So you want to stick to quality stocks that have proved themselves through earnings, even during these high inflationary environments, and preferably ones that pay out a dividend. Not solely looking at dividends, but if they are a quality stock and they pay out a dividend, then that is a double, sort of a double benefit there, right? So yeah. Downfall of Putin is coming. What is a good stock with maximum upside? I just went over some. Neo for life. Not really. Although I do think Neo will have, will have a run soon. But yes, lumber, blah, blah, blah. I have $12 strike price on wheat. That's going crazy. Good job. If you're trading wheat futures, very good job. What country are you in now? I'm in the U.S. Yeah, the last dude sounded sauce, not you, brother. Plastilina, thank you so much for confirming that it wasn't me. Thoughts on semiconductor stocks ETFs right now? Yeah, I think SOX-L and SOX, those are definitely, they're still a head and shoulders here, but I think they are at levels where you can start nibbling. SOX-L is a lot cheaper than SOX, which is SOXX. But keep in mind that SOXL is a 3 times leveraged ETF. However, it is a cheaper way to invest in the semiconductor ETF because SOXX is rather expensive. All right, let's see. Don't go near Nike being FL. Do not go near Nike being removed. Nike's not only being removed from Foot Locker. Nike's being removed. And Nike's going direct to consumer, right? Because they figured that not only does that make their product more valuable, but that it basically, you know, cuts out the middlemen, and there is more money to be made by going direct to consumer. So Nike has been on this path of direct to consumer for a year now, right? And yeah, it's not just Foot Locker. Let's see. But, you know, we're talking about mainly apparel, right? Nike shoes will still sell at Foot Locker, obviously. I'm in Soxel, Pelosi, blah, blah, blah. Foot Locker equals Blockbuster. Not really. I mean, not really. But sure, yeah, whatever. You know, I'm not saying that it's something that should occupy a huge part of your portfolio, but looking at a high dividend yield value stock, you know, for a small percentage of your portfolio, I don't mind Foot Locker. Nike, I would buy in this dip. Nice dip. It also increases their margins. Yes, Led Zepp, correct. Tell me something about Baba and RH. I don't fuck with Baba at all. And RH, Restoration Hardware, or you mean Robinhood? All right. I think we've been going on for an hour and 45 minutes. Let me see if Powell's saying anything significant, and then I think I will likely jump off because I need to trade, guys. I haven't traded in almost 3 hours this morning.
Their wages, nominal wages, have gone up higher, more than inflation.
Okay. So, last question. When you and I spoke at the beginning of this year, and my time has expired, I'll ask it to you later on. And I thank you for your service, sir. I thank you for keeping us out of a recession. I think we built a better America by staying out of the recession. I yield back.
Thank you so much. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chair.
I mean, I have nothing against Jerome Powell. I actually like him. He's a likable dude. I think he's super smart. But this thank you for your service. I mean, at the end of the day, he's a chairman of a bank. And he's a chairman of a bank that is a private institution. It is not even, you know, I know the term federal is in the name, but it is not even a governmental body, right? It's a private central bank, and thanking the chairman of a bank for their service is hilarious, right? I mean, he's not in the military. That last guy was thanking Jerome Powell and said, "Thank you for keeping us out of a recession." I mean, a lot of that has to do with the lawmaker policy as well, right? He's not the one that passed stimulus or printed helicopter money or whatever. But I mean, you know, those words are ironic, especially if we do fall into a recession. I personally don't think we will, but stagflation, as I mentioned earlier on the stream, is definitely a very real threat. And if that is the case, then the Fed's policies will have potentially played a part in that, right? So thanking the chair of a central bank for their service, one, prematurely, two, is hilarious that, they're sort of being treated as public servants when the Federal Reserve is not a public body, right? But
the U.S. dollar is sound money, yes. The threats to the U.S. dollar as the reserve currency really, in the near term, are to displace the U.S. dollar as the reserve currency, if that's your question. You need to be a very attractive place to hold large amounts of reserves.
It's really different than that, because we are probably still going to be the reserve currency, since the world grades on a curve, and frankly, the planet's never had this much debt since World War II. So all of the countries around the world did similar things. The discipline of the Bretton Woods era was gold. I don't know that there's magic just in gold, but there is magic in discipline. So if you look at sound money being defined by a stable store of value, an efficient means of an exchange, and a trusted record of an account, you've at least taken some dings on store of value. And so as you've seen people decide to filter transactions and develop technology and regulatory frameworks that are intended to be able to filter transactions, it's not as trusted or efficient as a means of exchange or a record of account. And so those kinds of things, not so much do we do okay on the curve, but is it truly sound?
I'm not sure I followed the last part, but I do think that, look, inflation is indisputably too high. We are using our tools to bring inflation back down to levels of price stability, and we will accomplish that task. Longer term, the U.S. dollar is easily the best currency, and it's because of what I just said. It's also because of the rule of law and the fact that we're the incumbent, and we as long as we observe the rule of law and keep the dollar relatively, keep inflation low and predictable, that will remain the reserve currency.
Yeah, okay. So thank you, Chairman. And look, historically, there have been multiple reserve currencies, and generally, when something loses its status as reserve currency, it's not just because of other things that unfold, but it's because the value is debased. And we can come up with fancy words like modern monetary theory or quantitative easing or, similar to quantitative easing, but not really the same. When the Federal Reserve's balance sheet's growing, in a way it represents the Fed as the lender of last resort. We're not constrained by the taxes we collect. We're not even constrained by the amount of money the world will lend us. We're constrained only by the will of Congress to not spend more. And what are you going to do? Not cover the spending, the prolific spending by Congress. So moving on, just talking about, the Fed's role, of course, stable prices is really one component. The other is full employment. And I wonder if you think, in light of Mr. Perlmutter's reference to Chart 2, if Chart 4, which is the labor force participation rate, trends the right way. And as you link to the next thing, as a regulator, there's a lot of pressure for you to do ESG. What can the Fed do, and what does Congress need to do to strike those balances?
With relative to ESG?
And full employment.
Well, full employment, I think most members of the FOMC now think we are at labor market conditions that are consistent with maximum employment.
With 60% labor force participation? 62?
I mean, the maximum employment can never be higher than the level that's consistent with price stability.
The gentleman's time has expired.
I think we're at that level.
Thank you.
At least.
The gentleman from Illinois, Mr. Foster, who is also the chair of the Task Force on Artificial Intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. And I'd like to add to Representative Perlmutter's list of your triumphs the record level of small business formation. And so I think...
All right, guys. I think we got the crux of what Papa Jerome is saying. Basically, that we're expecting a 0.25 basis point or a 25 basis point rate hike by the next Fed meeting, but it is all evolving. It's going to depend on the geopolitical affairs. It's going to depend on how bad inflation is. Again, I've gone over the price of wheat, the price of oil, the price of lumber. Everything has skyrocketed by tens of percentage points in February. I am so curious to see what this CPI number is going to look like in February. If it comes in at 8% or above, I think that the Fed's hands are tied. And maybe by then, as I said, we are seeing news sources that Russia and Ukraine might meet tonight as of the time of this live, right? So if we see a ceasefire, then, or if there's a foreseeable end to that conflict and inflation is crazy, the Fed will have to act aggressively to tamp down inflation. And we will likely see a scenario similar to what we saw back after the FOMC meeting in 2019, where the Fed signaled that they were going to be more aggressive with regards to the balance sheet, and we saw the markets drop further. So we could see a further drop for sure. I don't think this is yet max pain for the market. However, I don't think that really the markets are set up for a severe bear market. I don't think that's the case at all. Earnings are astronomical, especially as it relates to the mega cap stocks. Most stocks, I think something like over 90 or 95% of stocks have seen a bear market already. We saw a bubble burst with SPACs. We saw a bubble burst with recent IPOs, a bubble burst with high beta stocks. Like there was a .com level bubble burst in those stocks. It was only the handful of mega cap stocks that were keeping the stock market up, right? So it was only really Apple, Tesla, Google, etc. Otherwise, even Tesla, I mean, really saw a bear market when it dropped from that 1250 range all the way to below 700 briefly. But, those handful of stocks that reign supreme in the NASDAQ and the S&P 500, that is what was keeping the stock market afloat. But most other stocks tanked to hell, to Dante's Inferno. So I don't think that this is yet going to be the extent of a drop. I do think we could see a further drop, especially if the inflation numbers on March 10th are, just stupid high. We are now seeing a death cross on the Qs, by the way, between the 50-day moving average and the 200-day moving average, signaling that there could be further downside. However, I am, like I said earlier in the stream, I am a buyer of certain things here, being very selective about my buys. The indices being in that list of buys for sure for the long term. SPY-V, Google, Intel, and a handful of value stocks that pay a nice dividend, right? So that is really the crux of what happened today. He did mention the balance sheet runoff again, but didn't spend too much time on it. And yeah, we'll see what goes on between Russia and Ukraine tonight. Hopefully they meet. Hopefully not for the purposes of the market. Fuck the market. Hopefully for the purposes of humanity and, seeing an end to the conflict, that we get to some sort of ceasefire and, that is the extent of the bloodshed, that we see no more fighting. I'm cynical by nature, so, I'm not holding my breath, but I hope that is the case. Anyway, do you guys have any last minute questions for me before I sign off? I don't want to leave any of you guys hanging, but before you leave, hit that thumbs up, guys, so that in the future, folks can find these live streams, right? Can you confirm Travel Trader 66 isn't you? Yeah, that's not me. There's a lot of scammers out there. I will never contact you unprovoked or sort of unapproached. So yeah, if anyone's contacting you saying that they're me, it's probably not me. What's the split on Google? 20 for 1. 20 for 1. So take Google's price today and divide it by 20. That's going to be the price of Google after the split. All right. Semiconductor stock prices not rising. Look at Intel. Intel stock price is rising because Intel was the one semiconductor that was mentioned. The death cross, I'm going to short. Be careful when you short. Look at, make sure you're looking at levels diligently and you're looking at the chart diligently. When is the Google split? No effective date yet, but keep your eye out for it and actually Google it. Would you choose Intel over AMD, Nvidia? Right now, yeah, I think there's more upside in Intel. What are you buying? Oh my God, I just went over this ad nauseum. Rewind the tape. Is it Goog or Google splitting? Both. They're both the same. Just one has voting rights and the other one doesn't. The reason I choose Google with an L is because it's more liquid on the option side. But it's the same. It's the same. All right. Puts for April 14th expiry. If you're looking to hedge, I wouldn't count that as a main position. I'm not going to be shorting as a main position, right? But as a hedge, sure. Yeah, as a hedge, sure. Still need to join your trade group. Appreciate your insights. Yeah, guys. I definitely enjoy doing these. Thank you guys so much for joining the stream. For some reason, the camera is down. I'm not sure why. That is weird. Let me see. Hold on. I think the camera overheated or something. But yeah, guys. So I will thank you guys for joining the stream. I will see most of you on the Discord. And yeah, we will continue trading throughout the day. But thank you guys so much, and I will catch you next time. Thank you for joining. Thank you for those that donated to St. Jude's. And peace.